Hey guys, good afternoon and welcome to the CNBC TV18 Mumbai newsroom. I'm Pavitra, with me is Ekta, and you're tuned into MF Corner. Now today we're going to talk about a space that has been very hot. The Midcap index, even after the recent pullback, is up almost 30% for this year, and that has of course led to flows into this category of mutual funds only rising month after month. The latest August data, if you look at that, shows a big jump in inflows. That figure has risen to around 2,500 crore rupees. But what we wanted to understand on this episode is what managers are doing now. Are they having a tough time deploying this kind of big rush of money that has come in? Are they increasing their cash? Would they even recognize this pocket when shot up so sharply? So, Ekta, to answer all of these questions, we have a Midcap fund manager with us.
Hi, Pavitra. Yes, absolutely. We have a Midcap fund manager this afternoon with us. We have with us Ankit Jain, who is a fund manager equity at Mirae Investment Managers India, to talk about the Midcap space. Ankit, hi, welcome to the show. Well, let's start with the first question. You know, the Midcap space has been buzzing, not only in the past few months, but this entire year, and we've seen a big jump in inflows to around 2,500 crores in August. Do you think equity flows will continue to be dominated by this part of the market?
Yeah, hi. Thank you for giving me this opportunity. Yes, you are right. If we look into mid-cap space, has been seeing very good inflows from around 1,500 crore average monthly last. That has been inched up to around 1,800 odd crore by TD. And last month, as you rightly pointed out, it has touched all high at around 2,500 odd crore. So sometimes, asset allocation is clearly a function of good near-term returns, which has been the case in the mid-cap segment, which has seen almost 18% outperformance over large cap on YTD basis. So it is up almost at around 30 odd percent. But in inflows, good part is that even SIP book in the segment has almost doubled to around 1,800 odd crore on monthly basis from around 900 odd crore couple of years back. So which typically speaks about that tenure of investors is also inching up over time, and which is clearly is a very, very good thing from the overall space point of view.
Okay, Ankit, thanks a lot for joining us. This is Pavitra. So, last week we had that one single session where we saw the mid-cap index drop 3%. It scared everyone a little bit. Do you think that's just a one-off, or do you think that because of this kind of we've seen, we could get a bigger correction as well here?
Yes, given, let's say, around 30% in a short span of time, by TD last 7-8 months, minor correction is always healthy for the market, which might always be driven by some worry around maybe, let's say, crude oil price has really inched up from the lows, and also expensive valuation is into certain pockets. Having said that, overall earnings growth in the markets are pretty good, pretty broad based, with contribution across different sectors. And in that context, the market really, particularly mid-cap segment, looks a bit expensive from the near-term standpoint, with valuations premium being 15 to 25 odd percent versus historical average. But it looks still, I think, far more reasonable from the longer-term standpoint, more so when we see that earnings growth visibility.
Okay, all right. Well, the other aspect is, Ankit, money is rushing into the mid-cap. Valuations have also risen. Do you think it's too much money, way too fast? And is it a good time to be investing in a mid-cap fund just because of how expensive it might be?
If you look into mid-cap valuations on 1 year forward basis is at around 23x. And this is clearly expensive in historical context. When it used to be maybe at around 16, 17 odd x. So clearly, and more so, let's say if you look into valuation premium to large cap is at this point of a time significantly higher at around 25%. So some part of it can be explained by good earnings growth outlook. However, fund flows also do play its own part to create exuberance into certain pockets of the market. So overall, if you look into clearly with good all-around improvement across macros, GDP growth, interest rate peaking out, current account deficit under control, I think, and plus on top of that, there's been significant strengthening of micros. Across different companies, you look into improvement in balance sheets, cash flow. So to that extent, I think earnings growth outlook is good. which might help in sustaining some of these premium valuations. But clearly, if you look into, let's say, last 10-year mid-cap return CAGR is at around 20 odd percent. And out of which, I mean, almost half of it has come by way of valuation re-rating. So having done, I think, lot of valuation re-rating has already happened. So from here on, expectations to pan out, the earnings growth has to do all the heavy lifting. So to that extent, from near-term standpoint, we do clearly prefer large caps over mid caps because we do see more margin of safety out there. But clearly, I think with 5 years sort of a time horizon, mid cap do offer higher earnings growth potential, and to that extent, we continue to remain positive there from that time frame in mind.
Okay, I think that's fair warning that, if you are looking at a short period, even a kind of period, you're perhaps better with the large caps just for that safety over a mid caps. But, for a longer period, could be a very beneficial pocket. Ankit, you were just mentioning the valuations. Currently, the mid-cap index is at around 23 times, and historically, it has been at around 16 to 17 times. At what point would you begin to worry? Would you say that now is the time to just completely stop looking at mid-caps because there's too much froth? Currently, it's at 23%. What level does it have to get for you to actually be too worried?
Yeah, no, so at an aggregate level, clearly valuations are expensive, but at any given point of a time, there will always be pockets where, there will be decent sort of opportunity, balanced risk reward, margin of safety. So to that extent, that is how we are playing. So at this point, if you look into sectors like, let's say, financials, pharmaceutical, maybe, and consumer discretionary, I think some of these sectors do offer, I think it's still reasonable margin of safety with decent earnings growth visibility. That if you look into certain pockets like which has seen I think quite a bit of a run up, maybe capital goods, some of these themes are looking a bit more expensive to us at this point of a time. So having said that, at an aggregate index level, clearly valuations looks expensive, but within that there are pockets of opportunity, and that is how we are incrementally trying to develop.
Okay, fair enough. But Ankit, would you recommend maybe to your clients a multi-cap or a flexi-cap fund over a mid-cap fund right now?
Yes, absolutely. I mean, if you look into from, let's say, near-term 1 year standpoint, maybe flexi as a category typically do have larger proportion of large cap. And to that extent, as I mentioned, that maybe from 1 year time horizon standpoint, maybe large cap is a better place. So clearly, I think flexicap as a category, which typically do have 60-70% large cap proportion, is a relatively better bet. But having said that, as I mentioned, that sheerly from the earnings growth potential standpoint, midcap continues to remain a sweet spot in the market, and that is how one should approach with maybe 5 years sort of a time horizon.
All right, that's good advice for anyone who's looking to invest. But let's now talk about the fund manager's perspective. Ankit, are you as a fund manager having a tough time employing this sudden rush of money? Because, I was talking to some small cap fund managers earlier. I'm sure a lot of them have stopped lump sum investments as well, just because they're saying we don't know where to put this kind of money. Is that happening in the mid cap space as well?
Yes, if you look into higher inflow in particular market cap segment as a percentage of to clearly impact deployment. More so in mid-cap space, given one has to invest within the same set of universe of 150 companies, right? But despite of increase in free float market cap over time, mutual fund ownership as a percentage of free float market cap has also gone up. So it is now almost at around 30 odd percent versus 20, 21, 22 odd percent 2-3 years back. So to that extent, clearly, sometimes ability to deploy in a right manner, more so at a higher scale, becomes a bit of a challenge. But having said that, clearly, if you look into at an industry level, yes, maybe mid-cap funds cash levels might have gone up, but we always, used to have relatively lower sort of a cash levels in the fund. And as of now, also we are at around 3-4% of the AUM. Maybe in the past might used to be at around 2% of the AUM.
Okay, that is interesting to know. Ankit, we have lots more questions. For now, we have to take a mandatory break on the show. We'll be back in just 2 minutes to understand more of what you are doing with this big rush of money.
Welcome back. You're still tuned into MF Corner. We still have with us Ankit Jain to talk about the entire mid-cap space, which has really been the focus this year. Well, the next question which is really on our radar is, what is the cash position for your mid-cap fund now? What is the highest it's ever been? Because a report shows that several fund houses have increased their cash holdings recently.
Yes. So typically, we basically tend to have relatively lower cash position, in our funds. So historically, it has been maybe at around 2% of AUM, which maybe might have been inched up to maybe around 3.5, 4% as of now. But still, as I mentioned, that there are pockets of opportunities in the market to really deploy, and that is how we are. We are trying to approach the market.
So is this the highest your cash position has ever been, 3 to 4%, or it has gone above this? Any time through the past few years?
Yeah, absolutely. Maybe 3.5 might be on the highest side.
Okay, got that. So that is on the cash position. But now let's talk about, your strategy. For example, at this point in time, if you had 1,000 crores, which you had to put into the mid-cap universe, how would you really go about it? We've already seen a big run-up. So what would your strategy look like here?
Yeah, sure. So if you look into really, mid-cap is an excellent market segment from longer-term standpoint, given their potential to deliver higher earnings growth over longer time horizon. So if you really, but clearly it boils down onto the time horizon as well as the starting point of valuations, right? If you look into last 10 years, CAGR return in mid-cap indices has been around 21% CAGR. And probably half of it, or in fact, maybe slightly higher than that, might have been driven by the earnings growth. But even valuation has played a very, very important part to really deliver 21% sort of CAGR return over last 10 years. And as things stand, clearly basically starting valuations, as I mentioned, that 23 times is on the higher side. Really from here on, really returns to be made. Clearly, earnings growth has to do all the heavy lifting. So from the margin of safety standpoint and sectoral standpoint particularly, we will be very, very careful and really try to deploy incremental money around in the sectors where we are far more comfortable or with reasonable margin of safety. So as I mentioned, that maybe financials, pharmaceutical, consumer discretionary, some of these sectors incrementally we would like to deploy, and we are overweight on some of these sectors. But I will be cautious on fresh deployment across sectors like maybe capital goods, defense, which has extraordinary run in last couple of years. So having said that, whatever corpus to be deployed in mid-cap fund has to be looked from the time horizon standpoint, maybe 5 years. I think it still continues to remain, I think, one of the best segment in the market. But clearly, I think return expectations from here on at this point of a time where valuations are has to be more driven by the earnings growth expectations, and which we believe, given, I think, pretty good macros as well as micros playing out, I think earnings growth should still, I think, continue to chug along pretty well going forward.
Okay, all right. But Ankit, within the mid-cap space, while there are several opportunities, there are also names that can be extremely risky. So how do you play that? Do you think active is maybe a better way to approach the small mid-cap as well as the micro-cap investing space, where there is an experienced fund manager making his pick?
Yeah, absolutely. If you look into India, it's still stock picker market with potential to, I think, risk-adjusted alpha over a period of time. Over time, yes, but I agree with you that with more passive money chasing into the index, magnitude of alpha might come down over time. So to that extent, I will still say that active continues to remain, I think, better bet, because as you rightly pointed out that because while playing through the passive, you are playing through each and every constituents of the indices, and maybe some of the pockets might be very, very risky to really bet on. And while really giving in money to some experienced fund manager, they can clearly decipher out, both of these segments. And as I mentioned that over time, particularly in mid-cap and small-cap segment, I think potential of alpha generation still remains.
Okay, Ankit, just going back to the previous question where, you were talking about financials, pharma, consumer discretionary. These are some pockets where you perhaps still see some value. But break it up for us. How are you going to allocate? If you are a fund manager now, you have to, put in, say, break it up into percentage of what you would put into which sector.
Typically, sectoral allocation is also a function benchmark sectoral weight. So to that extent, if we have to look into, let's say, mid-cap fund, which to follow Nifty mid-cap 150 indices, clearly financials remains the highest weightage sector. Okay. So maybe around 20% out there. And even if, let's say, we are overweight, we will be overweight by, let's say, certain percentage out there. So maybe 1/4 allocation towards financials, and then maybe followed by consumer discretionary and pharma. I think these three sectors put together may be closer to 45% typically. I think that that should be the, I think, pretty much right. Right sort of allocation. Okay. And plus, let's say in many of the other sectors, it is again based on bottom-up stock selection. That is typically a diversified fund manager to work on.
Okay. All right. Well, Ankit, this has been a year where the SIPs go through the roof as well. The number of investors and people who've opened demat accounts as well come in at investors. So what is your advice to a retail investor who's looking to invest in a mid-cap fund now? What is the minimum time horizon they should consider, and what is a good checklist to have when they are picking a mid-cap scheme?
Yeah, so as I mentioned, that ideal time horizon has to be 5 years plus while investing in the mid-cap fund. Ideally, longer is the time horizon, better it is. And in fact, higher is the chances to get benefited out of the investment thesis to play out, right? More so in case of mid-cap segment, when over time, I think a large amount of return is also being made by way of valuation re-rating over time. So if any fund manager taking any sort of a call, investment thesis to really play out, sometimes might take much longer. So to that extent, I think 5 year plus is a perfect time horizon, and through SIP, even sort of a better into the mid-cap funds. What we have seen, most of the data do also suggest that even SIP book has also increased significantly over time. Clearly, the second part of your question is about picking up any mid-cap fund. What one should look at it is, one is about the basically stability of the returns across market cycle, right? Because typically there is a higher volatility while investing into the mid-cap fund. So I think key checklist has to be that across the cycle, how the fund is performing. So that is the key checklist. Second is clearly fund manager experience and investment philosophy. That is, I think, the key sort of aspect. And third is about, I think, the risk-adjusted return, which is typically being calculated through Sharpe ratio on yearly basis versus the benchmark. So I think on all of these three parameters, if one is trying to evaluate the I think might throw out the better sort of a picture.
All right, Ankit, that's a very enriching chat with you on, how you can go about investing in the mid-cap space, and also interesting to get the fund manager's perspective of how you are looking at this pocket, considering that we've already seen such a run-up. So thank you once again for joining us on this edition of MF Corner. With that, from Ekta and me, it's curtains down on the show. Stay tuned. There's lots more action when we come back.